Well, the Federal Reserve is raising interest rates yet again as inflation continues to rise. The recent increase brings interest levels to the highest point since 2008. News 8's Danielle Zulkowski has more on the impact.
It will raise interest rates 75 points or 0.75% to help curb inflation. Experts say this is not an immediate fix and will likely take time before Americans can see some relief.
It causes the cost of money to increase, and it causes some companies to not be able to afford that increased cost of money. And so the result of that is that the economy, in theory, will slow down. Prices will eventually moderate. They may not come down, but they will stop rising.
Fitter says raising the interest rates on things like business, home, and car loans, as well as credit cards, will help to slow the economy and curb inflation, but could be a painful transition for working Americans.
The economy will slow, and so that could mean that there's some struggle in the economy. That is to say, people might jobs might become less plentiful, and they may have some difficulties if we tip into recession to keep their jobs.
This is the worst case of inflation in over 40 years. Fitter says there is still time to get it under control before it's permanent.
If the Fed doesn't take action, we're at risk of that inflation rate becoming embedded, meaning prices go up, people's wages go up, which in turn drives prices up, which in turn causes wages to go up, and this vicious cycle of inflation escalating out of control. We're not there yet, but there is a potential for that to happen if the Federal Reserve doesn't continue to act.
Fitter says the other way to help curb inflation would be to increase the supply of goods on the market. In the newsroom, Danielle Zulkowski, Wish TV, wishtv.com, and follow us on Facebook.